When the markets crashed in 2008, the world watched in real time as everything fell apart. Lehman Brothers collapsed. Bear Stearns evaporated. Your neighbor lost their house. Your parents lost half their retirement savings. When the dust settled, everyone agreed on what the problem was. The banks were reckless. They gambled with our money. They weren't regulated enough, so we regulated them. And for almost 2 decades now, politicians have been patting themselves. Economists have been writing papers about how we fix the system. And the public's been told the same thing over and over. We learned our lesson. It won't happen again. Except we learned the wrong lesson entirely. And the fact that almost nobody realizes this, that's exactly why what's coming is going to be so much worse. Here's what actually happened in 2008, the part that didn't make it into the Netflix documentaries or the congressional hearings. The crash wasn't caused by a few rogue traders or some technical glitch in the system. The crash showed something basic about how modern finance actually works. The entire thing's built to do one thing above all else: move risk around until nobody can see who's actually holding it. That's not a bug. That's the whole point. Banks didn't accidentally create mortgage-backed securities that were too complex to understand. They built them that way on purpose. The complexity was the point, because if nobody can track where the risk actually is, you can keep selling it, slicing it, repackaging it, and collecting fees at every step. It's not fraud in the legal sense. It's just what happens when you let financial engineering run wild in a system that pays people for short-term profits over long-term stability. So when regulators came in after 2008 and said, banks need to hold more capital, banks need to be more transparent, banks need stress tests, they were treating the symptom, not the disease. They made banks safer, sure, but they didn't change the underlying incentive structure. They didn't kill the profit motive for hiding risk. They just made it more expensive for banks to hide risk on their own books. And Wall Street, being Wall Street, didn't stop playing the game. They just changed the rules. Within a few years of Dodd-Frank passing, something interesting started happening. Banks started saying no to loans they would have made before. Not mortgages, those were already scorched earth. I'm talking about business loans. Mid-market companies needing money to expand, leveraged buyouts, anything that involved real risk and needed capital the banks now had to hold in reserve. It wasn't worth it anymore. Too expensive. Too much regulatory scrutiny. But here's the thing. That demand for capital didn't disappear. Companies still needed money. Private equity firms still wanted to buy companies with debt. The appetite for risk was still there. So where'd it go? Into a parallel financial system that most people have never heard of. A shadow banking sector that exploded in size right under everyone's nose, while regulators were busy making sure traditional banks were following the new rules. It's called private credit, and it's now a $1.7 trillion industry. Let me put that in perspective. That's roughly the size of the entire junk bond market. It's bigger than the GDP of Canada, and it's growing faster than almost any other part of finance. Here's how it works and why it's terrifying. Let's say you run a mid-sized healthcare company. You want to buy a competitor. You need $200 million. You used to go to a bank. Now the bank says no, too much hassle. So you get introduced to a private credit fund. Could be Apollo, Ares, Blackstone, one of the big names. They say yes immediately. Why? Because they're not banks. They're not regulated like banks. They don't have to hold capital reserves. They don't have to report to the Fed. They're private entities making private contracts, so they give you the $200 million. But the terms are different from a bank loan. With a bank, their covenants, rules you've got to follow. If your revenue drops below a certain level, the bank can step in. If you try to take on more debt, you need permission. They're guardrails. With private credit, especially over the last few years, those guardrails have been disappearing. They're called covenant-light loans, and they now make up most of the private credit market. What's covenant-light mean in practice? It means you can miss payments and it's not technically a default. It means you can sell off your best assets and the lender can't stop you. It means you can take on even more debt from someone else. And the original lenders got almost no way to fight back. It's like getting a credit card with no spending limit, no monthly bill, and the debt only becomes real when you're completely bankrupt and can't possibly pay it back. Now, you might be thinking, Okay, but that's the lender's problem. If they're dumb enough to make those loans, let them lose money. And you'd be right, except for one thing. Where do you think that money's coming from? It's coming from pension funds, teacher retirement systems, university endowments, insurance companies, basically institutional investors who manage regular people's money and are desperate for returns. See, these funds promise their members 7, 8, sometimes 9% annual returns. But in a world where government bonds pay 3% and the stock market's volatile, where do you get those returns? You call up Blackstone. They pitch you a private credit fund returning 11% every year. You wire them $500 million of teacher pension money. Blackstone bundles that with money from other pensions, other endowments, and loans it out to over-leveraged companies with weak covenants. They charge high interest rates because it's risky, which is how they generate those returns. And your pension fund's happy because the quarterly statements look great. Until they don't, because here's what almost nobody outside the industry gets. Your pension fund can't pull that money out. It's locked up for 7, 10, sometimes 12 years. And during that time, they've got almost zero visibility into what's actually happening with those loans. They get reports, but those reports are backward-looking, cleaned up, and written by the same people who need to keep raising money next quarter. So right now, today, there are trillions of dollars in loans sitting in these private funds, borrowed by over-leveraged companies, with weak covenants, funded by pensions that can't take their money back, with almost no regulatory oversight and no public reporting requirements. Does that sound familiar? It should. It's the same basic structure as 2008. The risk's hidden, the leverage is insane, the incentives were all wrong, and the people holding the bag are ordinary people who've got no idea they're even in the game. The difference is, this time it's not in the regulated banking system where the Fed can see it. It's in private markets, invisible, by design, and it's starting to crack. Commercial real estate's the canary in the coal mine. Since COVID, office buildings in major cities are half empty. Nobody's going back to the office 5 days a week. Companies are downsizing their space. But those buildings were bought with massive loans, often from private credit funds, based on rental income that doesn't exist anymore. Right now, building owners are on the phone with lenders, quietly restructuring, begging for extensions. And the lenders are saying yes, because the second they admit the building's worth half what they loaned against it, they've got to mark down the value of their entire fund. Which means telling pension investors their returns aren't actually 11%, they're negative 3%. Which means pension shortfalls. Which means either cutting benefits or begging state governments for bailouts. So instead, they extend and pretend, kick the can down the road, and hope that somehow, magically, office occupancy recovers. It won't. But by the time they admit that, the damage will be everywhere. This is happening right now. Not in some theoretical future, today. And it's not just real estate. It's retail companies bought out in leveraged buyouts. It's software companies that grew fast on cheap debt and are now refinancing at double the interest rate. It's healthcare roll-ups that were profitable on paper, but only because they kept buying and delaying costs. All of it's sitting in private credit funds. All of it's starting to strain, and none of it's visible until it's too late. You know what the most insane part is? The people running these funds are still collecting billions in management fees every year, regardless of whether the investments are actually making money. They've got zero incentive to hit the alarm. Their incentives to keep raising money, keep making loans, keep reporting good numbers, and collect fees until the music stops. When Lehman collapsed, everyone saw it. There was a single moment of failure. This time there won't be. It'll be 1,000 small defaults spread across 100 private funds, reported quarterly with a 6-month delay, hidden behind NDAs and institutional investor portals. By the time the public realizes what's happening, pension funds will already be broke, city budgets will already be in crisis, and the contagion will already be spreading, and everyone will act shocked. Nobody could have seen this coming. These were smart investors. The models all looked good. Except it's the same pattern. The exact same pattern. We just moved it somewhere you can't see it. And because you can't see it, you can't get ready for it. That's what 2008 was supposed to teach us. Not that banks are bad. That a system designed to hide risk will always eventually fail. We didn't learn that. We just made the hiding better. And instead of a sudden explosion, this time it's going to be a slow, invisible bleed. And now the bill's coming due.